Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
The Reserve Bank today hiked interest rates by a quarter percentage point to 6.5%. And that was mostly on expected lines. Actually, if you looked at our tweet, we even guessed the voting ratio, 5:1 in favor of the hike. Well, that's just by way of feeling pleased with one's forecast. But anyway, what else are the key takeaways beyond the rate decision? Beyond the rate decision, the big headline is that inflation forecast for the fourth quarter has been raised from 4.7 to 4.8. That's a distance away from 4% target. Also, inflation forecast for the first half, or rather the first quarter of FY20, is at 5%. Both are hawkish signs. But having said that, the Reserve Bank is otherwise not sounding so hawkish. It has largely retained its neutral stance. It has added that if global growth slows due to tariff wars, then oil prices could fall. It says that good rainfall could be disinflationary, but points out that paddy hasn't received enough rainfall. That could be inflationary. So RBI is actually pointing at a mixed picture. The sense, therefore, is that RBI isn't screaming that a rate hike is likely in October itself. It looks like it will be data dependent. But let the key men speak for themselves. Hear them out.
There is considerable uncertainty around the full impact of the MSP changes on inflation, which will only resolve in the next several months once the price support schemes are implemented and rolled out across the commodities. The committee decided to increase the policy rate by 25 basis points while maintaining the neutral stance of monetary policy. The committee reiterated its commitment to achieving the medium-term target for headline inflation of 4% on a durable basis while supporting growth.
The monetary policy transmission operates at several quarters of lags, and as a result, the two rate hikes of June and this policy will play out only in due course in our immediate projections, because they will take some time to bite on the inflation.
The trade skirmishes evolved into tariff wars, and now we are possibly at the beginning of currency wars. Given this, we have to ensure that we run a tight ship on the risks that we control to maximize the chances of ensuring macroeconomic stability and continuing with a growth profile. We do have things that are in our favor, which you are aware of, and if we continue along that path, we ensure that we don't add to the global risk profile that would adversely affect us.
Well, the central bank is forecasting a 5% CPI in the first quarter of next year, yet it reiterates that its target is 4% inflation. So, does it mean that it is not done with rate hikes? Will more come, and will they come quickly? Yet, bond prices rose after the rate hike and this inflation target. That's surprising. The rupee stood rock solid, as it was expected to, because of the hike, and NBFC and bank stocks fell. Now, this leaves a lot of unanswered questions, and to answer them, I have with me an elite panel. I'm joined by P.K. Gupta, Managing Director, State Bank of India; Manish Vadawan, Managing Director, Head of Fixed Income, HSBC; A. Prasanna, Chief Economist, ICICI Securities Primary Dealer. Gentlemen, thank you very much for joining me. Well, first to the Economist. How many more rate hikes does this sound like, Prasanna?
Well, if you're talking about this financial year, we are penciling in one more rate hike by December, and we think there is a chance of a further one more hike before the financial year ends. But if you're talking about this cycle, then clearly we are not done. I think there are more hikes in the offing in the next financial year as well.
Okay. Well, that would immediately beg the question, then why not change the stance? We've already had two hikes with a neutral stance. And if you're speaking of one more, then and if there is a clear gap between the inflation forecast and the inflation mandate that the MPC has, is the MPC behind the curve in terms of stance?
Well, I mean, we have to recall that with the neutral stance, this MPC has already cut rate once and hiked twice. So obviously, I think the question has to be put to them what exactly they mean by neutral. Perhaps it just shows that they are not comfortable wording it in any other manner. I mean, if you start talking about a tightening stance, probably they are worried that the financial market pricing will go out of hand. Maybe that could be one reason. But at the end of the day, I think in markets, actions speak louder than words. So the fact that they hiked twice, I mean, even if they say it's a neutral stance, it's clearly we are very much in the midst of a rate hike cycle.
Exactly. Then why did bond prices rise today after the rate hike and after the central bank put on the table inflation forecast, which quite clearly indicates that more work is left to be done on the rate hiking cycle, 5% in the first quarter of FY20. Manish, explain that to us. Why did bond prices rise? The yields actually fell from 7.79 to 7.7574.
I think, first of all, on the rate hike, I would call it an insurance hike, which RBI has done. And the way the market has reacted is, as market feels that there is a long pause which is coming from RBI, and it expects that for the next 6 months, there may not be any action on account of the uncertainties which the governor and the deputy governor pointed out in terms of inflation numbers or currency wars, etc. But, you know, we are headed into a long pause. This is what I also sense for the next 6 months. And in that, now the dynamics of the market, which is normal demand, supply, etc., play out. I think in that context only you saw this kind of a rally which happened. That explains more of that rally. But, you know, we will come to know the true picture in a few more days. It's too early to jump to a conclusion.
Okay. Well, to be fair, bank stocks fell and NBFC stocks also, I think, were under pressure. The Nifty Bank definitely was not among the winning candidates today. So, Manish, where would you place after this 3-4 days of position adjustment post-policy? Where do you think yields will settle? Will it be north of 7.8, considering that a hike has come?
Lata, I think from here onwards, as I mentioned, there would be a demand-supply issue. We'll have to look into the other factors which are pretty normal, which are like oil prices, what's happening in the international markets, and what happens to our FPI flows. Anyways, considering all these, numbers, what I'm talking about, the factors and the inflation numbers expected, I feel the range of 10-year bonds could be somewhere between, 7.65 to 7.95 in the next 6 months.
Okay, 7.65 to 7.95. So there is still some bit of, higher cost of money that could come through. Mr. Gupta, now what does this mean in terms of running the bank? Before I come to what it means to your own rates or the banking system's rates, what have you made of the policy? Do you think, are you smelling more hikes maybe in December, if not October?
So I think this hike was in any case expected, I think. So the RBI had delivered on what the market was really expecting. But, on this point about 4.8 or 5% inflation projections going forward, I think the way to look at it is, in terms of their mandate also, it is 4% plus minus 2%. But I think somehow we have stopped talking about plus minus 2%. We are talking only of 4%. So if you look at, that the inflation target is only 4% and nothing else, then probably more hikes are there. But if you say that, it's within the tolerance level of RBI, that 5% is not really off the mark, then probably, there could be some pauses. So I agree. I think the market, the way they have looked at it is that probably there is more certainty. Probably there will be some pauses that will happen actually. So even if, now the inflation goes to 4.8 or 5%, so what it does mean is that it is within the projections which the RBI themselves have laid out today actually. So I think that is how the market is reading it. But actually it does get translated into the interest rates hike by the banks or not. I think that is something which we will have to still wait and see actually. Okay. As the Deputy Governor himself said that, it does happen with a bit of a lag.
Yes. No, that's exactly my point. Both our experts are saying that, more hikes are likely. And there is a gap between the 5% inflation that is forecast and the 4% they have to achieve. they have to achieve a 4% inflation. Plus or minus is tolerated. But the goal is 4%, sir. And if it is 5% inflation in the first quarter of next year, then clearly the MPC, if it is true to its mandate, will have to hike. If as a banker you have that in mind, then are you, looking will you be looking to raise deposit rates sometime soon, even if not immediately?
But I think deposit rates are a function of the liquidity also. See, even the past hikes that have happened, so if you look at it, how the market has reacted, there have been small changes in the interest rates that have already happened, both on the deposit side as well as on the lending side. And now that we revise our rates practically every month on fixed dates, so what it means is that the changes are incremental and small. So they don't really make the headlines in terms of how much change has happened, but changes have been happening. The liquidity in the market has generally been neutral for the past few months now. It does go into the negative territory on few days, as we have seen in the last few days. But overall, I think the liquidity is comfortable at this point of time. The banks are sitting on excess SLR, even the LCR requirement, which is at 90%, most of the banks are way above that actually. So basically, again, the mismatches at some individual banks could probably lead to some banks hiking the interest rates. And the individual banks, the rates they offer would be dependent more on the liquidity position. Plus, some changes will happen if, some of the other banks change the rates actually. So, I think it will take some time for this to get translated into the actual rates that are being offered by the banks. But ultimately, I think at some point of time, the transmission will happen. It's a question of, I think, time now. Okay.
So clearly, the transmission is a function of the liquidity. Now, Prasanna, therefore, that question to you, is the MPC being true to its word if it does not tighten liquidity? If your goal is 4% inflation and you're saying that it is going to be 5%, and clearly the banker is telling you that the transmission will depend on liquidity, is it not incumbent that in the second half liquidity should be tightened if the RBI wants to be serious about getting to 4%?
So first of all, I think obviously the MPC doesn't control liquidity or even any of the tools which can impact on liquidity, right? I mean, in fact, they just control only the repo rate. Even the other parts of LAF system, they don't control. Second point is, of course, that on current projection or current trend, anyway, liquidity will tighten in second half. In the busy season, currency demand goes up. We don't expect any substantial inflows on the FX side. A lot of outflows have happened. So based on that, in any case, the liquidity will tighten, and RBI has not shown appetite for stepping up its OMO purchases at this point of time. So I guess it's a kind of a benign neglect, one can take it. The RBI also, I'm sure they have their own projections, 3 to 6 month projections they must be having, and they also must be looking at the same kind of data we are looking at. So I guess it's a tightening which is going to happen. It's an unannounced tightening which will happen on the liquidity front.
You expect, therefore, that banks will be borrowing a lot more from the RBI, and that is going to be the characteristic of the second half. It will be tight liquidity. Is that what you're saying, Prasanna? I take your point. It's not the MPCs. My question clearly was, should not the RBI be tightening liquidity? Do you think that your base case is that is going to happen in the second half, tight liquidity?
That is right. So I mean, to go back to your original question, yes, I mean, the rate stance and liquidity stance have to be consistent. So obviously, when we were cutting rates or when RBI was in accommodative stance, that time they eased liquidity. And now that they've started tightening, obviously the liquidity should also be tighter. And what I'm saying is it will become tighter, and they will allow it to become tighter. Now, whether they choose to say it in so many words, that's a different question. And at this point of time, probably they're not ready to do that.
Sure. What's your position on that, Manish? Will they walk the talk on liquidity? If their goal is 4%, RBI should be tightening liquidity. Will they? What's your sense for this, say, September-December quarter?
Lata, I think I would allude to what Prasanna is saying. What is going to happen is in the next 6 months, liquidity is going to be tightening on its own quite a lot in terms of the currency leakage, etc. And in fact, you will have to take a call on how much RBI will have to provide liquidity to bring it to normalcy. So, you know, if you take if you put two and two together, what the DJ Acharya said, liquidity is going to get tighter. I think now it's a matter of how much of OMOs RBI will have to manage, you know, to manage the liquidity to bring it to a neutral stance. So in fact, I would agree that you would see a consistent phase of liquidity tightness, in the sense the system borrowing from RBI for at least 3 to 6 months. And then we enter December, January, which we take a call on rates.
All right. Take your point entirely. That was the unasked question. Will you tighten liquidity, or will you allow liquidity to get tightened? And that obviously was therefore not answered. Acharya definitely described the situation so far and said that it was sometimes loose and sometimes tight, but a forecast on liquidity was not made. The message from our two experts is that liquidity will tighten, in which case you will start to see yields rising. That's one part of the takeaways. What is the takeaway on the external sector? We have to take a quick break. The governor gave us a hint of what he fears on the external front. We will start the chat on the external front with that. We are back in a jiffy.
The trade skirmishes evolved into tariff wars, and now we are possibly at the beginning of currency wars. Given this, we have to ensure that we run a tight ship on the risks that we control to maximize the chances of ensuring macroeconomic stability and continuing with a growth profile. We do have things that are in our favor, which you are aware of, and if we continue along that path, we ensure that we don't add to the global risk profile that would adversely affect us.
Okay. So one of the reasons perhaps for the rate hike also was to shore up the currency, because there is a possible strengthening of the US dollar and a contagion effect and currency wars and tariff wars. Prasanna, let me bring that to you. A rate hike strengthens the currency at a time when neighboring currencies, and a very big one at that, the yuan, has been steadily depreciating. Is the Reserve Bank doing any service to growth, economy, exports and current account deficit by keeping the rupee appreciated? Should it not be working overtime to allow it to depreciate?
Well, obviously this is something which you are trying to infer, because the stated reason, from whatever we can gather, for this rate hike is that inflation is higher than the target, right? I mean, that is the reason they are hiking. And in fact, if you extend that argument, RBI or the MPC will say that if currency depreciates and adds to inflationary pressures, they have to react. So in that sense, they are being consistent. So I think you can't fault them on that. But yes, I mean, from a sentiment point of view, or from a signaling point of view to foreign investors, I guess what we should look at is some of the other peer economies, like Indonesia, for example, have tightened monetary policy quite significantly. So maybe that is also acting or weighing on the RBI's mind, while the yuan depreciation is one part of it, like you mentioned. But on the other side, some of the other current account deficit countries in the region are actually tightening monetary policy. So maybe that is the other side of the argument which the RBI is weighing up. And as far as the depreciation goes, I mean, definitely on the nominal terms, there has been some depreciation. Even in real terms, there has been depreciation. Yes, I think there is an argument, or there is a case to be made that based on fundamentals, maybe rupee should depreciate more.
Exactly. If you look at the real effective exchange rate, then it is certainly not depreciated enough. I think it's still overvalued by over 15%.
Yeah, so I mean, obviously the RER has to be adjusted using productivity differentials and all that. That's of course a bigger argument. But yes, I mean, I'm just purely looking at current account deficit. Even after stripping out oil and gold, it has actually worsened. So in that sense, yes, I mean, the rupee should depreciate more. But then this is, I would submit here that this is not just a call purely taken by the RBI. The government also has an input into it. So my guess is that the USD INR, I think on nominal terms, I think there are certain critical levels, a 69 or a 70 level is not a level which policymakers want to see breached. And that is the reason why the intervention has been quite heavy in the last few months. And maybe that is indirectly also a contributory factor to the monetary policy stance.
That would be very unfortunate if for political economy reasons the rupee is not allowed to go where it ought to be for growth reasons. But then in that case, are you comfortable with the Reserve Bank's growth projection? 7.4 for this year and 7.5 for next year, first quarter or first half. But is that looking like an overestimation, Prasanna?
For this year, definitely not. I mean, we obviously we have not even brought down our estimate from where we were at the beginning of the financial year. I mean, despite oil going up, I mean, granted that was a downside risk. Also, what is happening in the global economy because of the trade skirmishes, again, that was a risk factor. But on the other hand, I mean, the monsoon is normal, and I think, like it was mentioned in the policy, with the MSP hikes, and if the government is able to implement or spend more money in the rural areas, it will support rural consumption. So from that point of view, we are not that worried about growth in the current year. Into next year, yes, I mean, at this point of time, it looks a bit optimistic, because many of these factors we are talking about will start playing a role. Also, the monetary tightening will play a role. And then we shouldn't forget there is a general election also, so how sentiment turns based on the results. So obviously it's a bit difficult to take a call into next year, but at this point of time, I would agree, yeah. I mean, for next year, the outlook does look more clouded.
Okay, but what is your GDP forecast anyway for the current year?
It is 7.4%.
Okay, fine. I heard quite a few 7.1s and 2s in some previous panels. But Mr. Gupta, before we run out of time, I wanted to get one of the developmental issues out of the way. The RBI says that it will encourage co-origination of loans between banks and NBFCs, and that it will put out guidelines. What are you expecting on this? And will you be actively looking at strategic partnerships with NBFCs?
Yeah, definitely. I think from the bank's point of view, this has probably been the most important development that has happened today. See, what has happened is that the banks have this target of 40% PSL. But of late, there are a lot of NBFCs, fintechs that have come in, and they have been doing these small value loans. For the banks, actually, it's very costly to do these small value loans. NBFCs are typically, much better placed in terms of both productivity, efficiency, and cost-wise to do these loans, actually. So as of now, what has been happening is many NBFCs have been originating these loans, and the banks have been buying those portfolios from them. But I think this co-origination model will definitely be helpful, because based on a pre-agreed formula, so we can agree with the NBFC, they take a certain portion of the loan and the rest of it is taken by the bank. And they don't have to worry about the funding. So the bulk of the funding will come from the banks, and they can go on originating these loans. And how these loans are originated and how the recoveries happen, that is something which can be agreed upfront with them. So I think it's a win-win situation both for the NBFCs as well as for the banks, and it will definitely help the banks to achieve the PSL targets.
Oh, that's
but still have to wait and see what the guidelines are. But I'm sure that this will definitely help the banks.
What do you expect by way of guidelines at all? Why can't you tie up with them right away? What would you be waiting for?
No, I think in terms of risk sharing, whether RBI stipulates any minimum risk to be taken by the NBFC or by the banks, or in what form this agreement should be concluded, actually. So what should be the overall contours of the agreements that we signed with the NBFCs? I think so that is what probably we'll wait and see how it is done. So as of now, also this is done, but in a slightly different manner. But whether in terms of even what kind of commissions that can be paid on these kind of loans, I think that is something which we will have to wait and see.
Okay, well, very quickly, your take on this growth impact of the rate hikes. Both our experts say that liquidity could tighten and they are expecting further rate hikes. The OIS curve is also indicating that another rate hike is there. The one-year curve is indicating that. Mr. Gupta, if rates are hiked further and if liquidity tightens, what kind of impact will it have on credit growth? How much do you think the system will deliver this year?
No, see, already the system is growing at 12.8% year on year, okay? And the deposits are growing at close to 8%. So as it is, there is a mismatch. So there is going to be liquidity tightening going forward if these growth rates on the deposit as well as on the lending side continue. But at the same time, when I mentioned about liquidity, the context was that the banks in the past have not raised rates very aggressively because they had some liquidity.
Okay.
But some of this liquidity, how fast it can be converted into liquidity which can be used for the purpose of funding credit, I think that again is something which remains to be seen.
Okay.
From all indications, the liquidity will get tightened, and that banks will have to raise their rates.
Okay.
And if the current, of course, the lending, it's already growing at 12.8, and generally we are just at the beginning of what we normally call the busy season in terms of credit growth. So it can definitely go to 14-15%, in which case the liquidity could become a bigger issue.
Okay.
So even if the bank has excess SLR, but the question would be whether they can convert it into liquidity. I think that is something again which will have to be seen.
All right, gentlemen, completely out of time. Thank you very much, Mr. Gupta, Manish, and Prasanna for joining in. Key takeaways from our guests. Given the inflation target of 4%, one should expect that the Reserve Bank will hike, maybe not in October, but perhaps in December, and maybe yet again before the financial year ends. More importantly, it will perforce ensure that liquidity declines. Liquidity in the system always declines when the busy season starts, when the festive season starts, and all of us are withdrawing more cash. That tightens liquidity, and that in turn could push up rates. So while you may celebrate today that the likes of Mr. Gupta are not raising their lending and deposit rates just yet, it does look like in the second half the cost of money is going up. So NBFCs, watch out. Those of you who have shares in NBFCs, watch out. Those of you who have EMIs, watch out. Those of you who have savings, of course, probably have a good thing coming. We wrap up this special CNBC TV18 show. Thank you very much for watching.